All right, to our next conversation, we'll dive into some key dynamics shaping Nigeria's investment landscape. Despite a booming stock market, mutual fund assets remain almost entirely in money market and fixed income instruments, raising questions about cultural and economic risk aversion. And this is data coming from Chapel Hill Denham. Joining me now to unpack this, we have a favor to talk about. Is a portfolio manager at Chapel Hill Denham. Great to have you on the show.
Yeah, thank you. Thank you.
Right. So according to your recent data now, Nigerian mutual fund assets are about 99% concentrated in money market and fixed income products. What cultural or economic factors might be driving this extreme, risk aversion compared to the 40 to 60% equity allocation seen in, developed markets?
Yeah, thank you. So I'm going to be looking at this from three major points. If the first of which is when you look at the Nigerian macroeconomic space, you would see that we've been having a double-digit inflation figures, right? Let's say between 2020 and 2024, averaging about 18 to 20%, right? In fact, as of the end of 2024, inflation figure was around 34.8%. When you have such an inflationary pressured environment, what you would typically see investors do is that investors would seek to preserve their capital, right, and chase liquidity rather than putting their funds into an instrument that will deliver long-term return. The second point is when you look at the current interest rate environment, you would realize that there's been some sort of distortion, right, as we've had elevated macro MPR, right, over the last 5 years. So if you look at it, the MPR currently stands at 27.5%. That is somewhat elevated, right? And the environment has created some sort of performance, right, for the money market and fixed income market, right, which has given a little bit of comfort to Nigerian investors who would rather position their funds where there is safety, right, rather than looking for real return. So that's basically what we'll see. If you then look at this compared to what you would typically see in developed markets, where bond yields are usually around 2 to 5%, compared to what we have in our fixed income and money market, where you would see yields sub-20 levels and then high 20% levels. That is very, 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 very sort of encouraging for Nigerian investors when you look at it from a relative standpoint compared to what we have, in the US or developed market, where investors are sort of forced or put under pressure to look for real return in another market, which most of the times you would get in the equities market. I would also like to quickly touch base on the fact that the 2008 and 2009 crash, which sort of affected the equities market, is also sort of giving a traumatic experience for investors, right? The crash wasn't even the issue. It took the market about a decade to recover. And this recovery is a little bit slow compared to the recovery you would see in developed markets. So this also sort of shaped how investors behave in the Nigerian market and their dispositions towards equity. So the last thing I would say to answer this is the market demographics, right? If you look at it today, just like I said, the assets under management in the mutual fund is about 7 trillion when you remove AUMs in the alternative, and just 1% of that 7 trillion is actually invested in equity mutual funds. That says a lot. And the major thing is that I realized that 70% of those investors, right, are actually retail based. Right, they are retail investors, which means that Nigerian market is highly concentrated with retail investors compared to what we see in developed markets, where we have pension assets, insurance assets, dominating, the mutual fund space, and in such they are able to confidently, put in about 40 to 60% because those investors, those corporate investors, are long-term players, unlike what we see in the Nigerian market, where we have more retail. About 70% of the entire bucket of investors are retail guys.
All right. So, yeah, thank you for helping us paint that picture. But very quickly now, I would say the Paramount Fund reported a 12-month return of about 80.83%, significantly outperforming the NGX return of 57.68%. What specific elements of the fund's, free float weighted index approach likely contributed to this 23.15% alpha?
Yeah, thank you so much. So what I would just quickly say here is that from our strategy, it is free float index based, right? Compared to the ASI that is market cap based. So two things, assets, allocation effect and selection effect. So what we've done in the Paramount Fund over the last 12 years is that we add liquidity adjusted selections, right? Which meant that the stocks that we invested in are stocks that have very high liquidity and stocks that have large capitalization, which means that we are not just going to focus on stocks that have large cap, but stocks that have high liquidity also. So our strategy is free float driven, hence the need for us to invest in stocks that have high liquidity. So what I'm going to say here is this: if you look at the bucket of, if you look at the entire market, you would realize that most of the big names, most of the large cap stocks are not very, very liquid, right? So the Paramount Fund focuses on stocks that are big but also very liquid, and that has helped us in three things. Number one, you would realize that PFAs or large corporate investors most times focus on liquid stocks,
right?
And that is where the Paramount Fund has positioned itself, such that when there is an increased level of activity, the Paramount Fund is able to benefit in that regard. Number two, the Paramount Fund was also able to rebalance quickly based on our strategy because we have highly liquid stocks, which means that in the last 12 months, we were able to take advantage of market dynamics, market opportunity, compared to stocks that be illiquid, right? Which also means that when you come into the Paramount Fund, for example, what you would see is that there's even a possibility of having a 24-hour exit or entry, right? Because of how highly liquid, the fund is.
All right, very interesting because we've had stories, where investors, they buy a stock and because there's no liquidity and the free float is not as free as they wanted, they're not able to exit, that asset as they want. But, definitely we'll keep tracking how that plays out. Thank you so much. Favor Teogbade is a portfolio manager, Chapel Hill Denham. Thank you for coming on the show today.
All right, thank you.